The most significant challenge for us is in the headlines around retail. We've seen a strong narrative in the media for the last 12 to 18 months that retail is dead. And for us, that is simply not true. Our principal tenant is Canadian Tire, and they pay us over 90% of our rents. And quite simply, they are killing it. They recently reported their fourth quarter sales, and consistent with what we've seen over the past few years, they continue to demonstrate solid same-store sales growth year over year, quarter over quarter. Since our IPO a little more than 4 years ago, they have shown this positive trend, and their sales growth is greater than their rent growth to us. And therefore, their space with us has consistently become more affordable over the last 4 years. The other narrative around REITs in general in Canada is that investors should avoid landlords that have long-term leases. Canadian Tire has signed with us longer leases than average in our sector, and this is seen to be a negative for us. The truth is quite different from that headline. We get annual increases in rent from Canadian Tire, approximately 1.5% per average per year, and that drives bottom line to growth for our investors that is better than average. And so again, the headline is not consistent with the observation once you dig into the details. Operationally, we have one of the strongest balance sheets defending us against a rising interest rate environment because we have the longest term debt on average in the sector. We also have the least reliance on variable rate debt. So operationally, rising rates or inflation, if that is your expectation, are going to touch us later and less than they will touch other real estate operators in Canada.
So challenges, I don't know if it's necessarily challenges. Certainly what worries me is the fact that there's a lot of negative perception about retail real estate that is, I believe, overdone, and it's definitely worrying. I don't like seeing our share price and other retail REIT share prices as low as they are and trading at such significant discounts to net asset value. It tends to choke off a source of capital for us in order to continue growing our business. But other than that, for us as a developer, our challenge is always to continue to grow our pipeline and to adapt to changing market conditions.
It's NAFTA. If there's a challenge that I'm really concerned about, it is the lack of knowledge and lack of understanding of what would happen if Donald Trump tweeted that the NAFTA agreement was over.
I think the most significant challenge we'll face is a slowing residential market. I think one, because it's such a big part of the Canadian economy, it'll affect consumer confidence, but we would expect that the first 6 months of the year will show that Canada's largest housing market, the Greater Toronto area, will slow down, seem really almost from the last 5-year perspective, very low levels of sales and somewhat weak pricing. And so I think that'll be a challenge just as the consumer adjusts to the fact that the value of their home may actually be going down, not going up, and the ATM that was refinancing of housing will slow their expectation of what their home is worth today, what it might be worth tomorrow, and therefore their level of spending.